Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the long U.S. holiday trading week ending May 27th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is appropriate, is the breakout reel. Well, we had clearly had a very strong move this past week in the markets, finally, I guess. So let's go in and take a look at where we've been this week and then just kind of what I see on the horizon and where the pitfalls are as well as the opportunities. Let's take a look at the index performance. You can see for the week, man, there's a lot of green on that screen, huh? Well, for the weekly, there's a lot of green on the screen. Everybody up over 6% for the week. Dow, S&P, NASDAQ, Russell. The strongest week was NASDAQ. It was probably appropriate. It was down the most. Year to date, NASDAQ still in a bear market. Started at the beginning of the year. It's down more than that. The Russell is in correction territory year to date, but it is down in a bear market from all-time highs. The S&P is down about 12.76%, and the Dow is not in correction territory, came out of it only down 8.6%. Okay. You can see the PE ratio, the forward 12-month is a little over 17.5, 17.63. Dividend yield in the S&P is 154. And the 10-year Treasury 274. So the 10-year Treasury is higher by about 120 bips from the dividend yield. And then the earnings yield in the S&P is at 491. That's what's being paid right now for the market price overall. And the S&P yield over the 10-year Treasury is about 2.17%. However, the real yield when you factor in inflation is still a negative 3.5% or so. Current VIX finished out the week, actually fell down a little bit, about 12.6%, but it's still elevated. I mean, even with this big movement in the market, the VIX is still at 25.72. And you can see all sectors were in the green this week, the best and the worst performing sector. There wasn't a major sector in the S&P that finished in the red. The best was discretionary, up a whopping 9.51%. The worst was healthcare, but it was still up 3.27%. Energy is leading the way year to date, over 61%. Discretionary is leading to the downside. Year to date, 24.67%. With the indexes moving up this week, the Dow broke an 8-week losing streak. 8 weeks, guys. And you could take that streak, and we haven't had a streak like that since the early 1930s in the U.S. And the S&P and NASDAQ, not to be outdone, they had a 7-week losing streak that was broken this past week as well. Okay. So if we kind of take a look at what came out this week from economic data perspective, we're seeing the inflationary pressures is contributed to some softening in some of the early readings for the U.S. PMIs, coming in just a little bit in May, down about 2 points from 59 to about 57. Manufacturing output, new orders were strong, but input costs and output charges also increased a lot due to inflation. So on the services side, PMI came down a little bit from the prior month of 55 down to about 53.5. New sales growth also slowed. Input costs also increased, the highest level on record. That's going to factor its way through to what we end up paying at the point of sale, right? Cash register. And the April data from the Census Bureau showed that core durable good orders, taking out transportation, grew about 30 basis points, primarily because of inflation. So we're seeing some slowdown in the economy. And this past week, if we look at this, you can see in the Fed meeting minutes, it had some surprises in there. And that's what got the markets really bullish the last 3 days of the week. All members voicing support for a 50 basis point rate hike in the next meeting on June 15th, I believe. And then another 50 basis point rate hike in July. But then where they all went soft was the markets were expecting a 50 basis point rate hike in August, but they came back and said, we're going to take a look at it, hinting that maybe a 25 basis point or even pulling back on some of the rate hikes in the latter part of the year caused the markets to just get overly anxious and push prices up a lot higher. Okay. If the other thing that they saw this past week, the Feds are looking at is the PCE, the core price consumption expenditures, which I don't know why they use that as an inflation measure because it doesn't. It excludes food and energy, and what family doesn't need food, and generally what family doesn't need energy to get back and forth. But it ticked up about 30 basis points in April, in line with expectations. But on an annualized basis, this inflation matrix came in at 4.9% versus March's 5.2. So a little bit of a moderation. So the market saw that as a positive thing. And whether that's the true measure of inflation, which I don't believe it is, but it's what the Feds use. And so the markets go with what the Feds want to go with, whether it makes sense or not to exclude food and energy, because we all know food and energy is up double digits this year. Okay. And projected to go higher. But that little bit of a pullback in inflation and those comments in the Fed meeting minutes were enough to set the markets off to the upside. The other thing, as a result of this bullish price action, the 10-year Treasury yield traded a little bit lower as the market appeared to focus more on signs of slowing growth. As I mentioned, in the PMIs coming in just a little bit. Okay, so the Treasury 10-year and 30-year both traded down just a little. Now, if we go over to the European markets, you can see there pretty much in Europe everything was very similar in the green. 3, 2, 3, or 4% up for the week, right? ECB President Queen Bee Lagarde, she appeared to come out more hawkish, but she just reiterated what she said a couple of weeks ago, where the ECB is going to end their bond buying program in Q3 and then right after start hiking interest rates. But they're going to be a day late and a dollar short. Their economy is not as strong as the U.S. markets. They're having more difficulties with energy because of their dependence on Russia, trying to cut back. So their energy prices are going through the roof. Nat gas is going through the roof. They're having major problems. Okay. Although one bit of bright news, the Eurozone business activity held up a little bit better in May than most people thought. The composite PMI dipped. It did dip. It fell from 55.8 to 54.9. So it dipped a little bit, about a point or so. And meanwhile, over in the UK, PMI came in close to stagnating in May, with the index coming in at 51.8. Remember, everything over 50 is expansion, anything below 50 is contraction. Right at 50, you're at pure stagnation. But that's a 15-month low. In April, the UK PMI was at 58.2, so that's a big drop in the month of May. Okay, very big. Now, year to date, all the indexes are in the red. The Euro stocks, which is the 50 largest countries in Europe, are still in a correction territory for the year. The FTSE is still in the green year to date, 2.72%. And then, of course, if we go over and look at the Asian markets, you can see Japan, the Nikkei, was the only one in the red for the week, or in the green for the week, just 16 basis points, but it's red year to date. Same thing with China and Hang Seng, red for the week, just barely, but in correction territory year to date, right? This further surge in COVID cases in Beijing pretty much ignited a lot of fears of economic slowdown, and it hurt Japan. Worries about tightening global financial conditions and the impact that's going to have on economic growth, kind of weighed on Japanese sentiment. But optimistic retail earnings outlook and waning signs of overly aggressive interest rate hikes by the U.S. Fed kind of changed the sentiment just a little bit in the Nikkei to finish just above green, above the zero line for the week. China wasn't so lucky. Their markets are pretty weak over their slowing growth, which I think they're just all idiots here doing what they're doing, exacerbated by the Chinese government zero tolerance approach to COVID. It's just totally stupid. That's like saying, let's outlaw the flu. You're not going to stop it. Shanghai has been under a lockdown since late March. Late March. We're almost coming into June. They're gradually easing their restrictions as officials have started allowing more people out of their homes and businesses to reopen. The problems that's going to cause downstream in the supply chains, in goods being shipped. Keep in mind, Shanghai port is about 25% of the total cargo traffic globally. So that's going to cause a big damper. Now, it hadn't washed to our shores yet, but it will. And it's going to cause inflation to stay worryingly high. Okay. Now, what I'm going to do is I'm going to shift you to another chart here. Let me just switch the screen. Take a couple of seconds to get the new screen up. What I'm going to show you is a weekly chart of the S&P E-mini futures. All right. And on this chart, and I've shown this to you every week for the past month now. But the reason why I'm going to show you this chart is just to show you to beware of the market moves higher. Okay. As we get these rallies in a bear market or close to a bear market, like that rally there or this rally here, every one have been met by intense selling, and then the markets just get pushed down a good bit, right? So let's just come in here for the hell of it and look at the distance. This one looks like the longest distance from there to there. You'll be surprised just how wide that distance is before we gave it all up and then had that record run of 7 or 8 weeks in a row, depending on the index. Okay. I've got here 1, 2, 3, 4, 5, 6, 7 weeks in a row for the S&P on this weekly chart. All right. So let's take a look at it and see what it means. What I'm going to do is I'm going to zoom in on this chart here and then just look at this, and then we'll zoom back out for a second. So let's zoom in. Again, a weekly chart. So if I were to come in here and measure this, let's start. I won't even start at that low here. Let's give it a break because it came down here. It went all the way up and then rolled back down. So let's just go from this low right here, right? Only took 3 days. And I go to the intraday high right there, right? So the markets moved in 3 days, intraday high, 476 S&P points. 3 weeks. So we had a 3-week rally, because this is a weekly chart. It moved 11.44% up, and it fell again. So if I were to take this rally and superimpose it here, what does that suggest for an upside here? So if I just take it and move it over, go to the lows right here, the previous day, it suggests an up move up to about 4,300, which is right here at that level where we've got a lot of support. Or let's just say a lot of resistance, rather. We got it right there. And if I were to extend that line over, I mean, you can see all of these intraday moves, but we pretty much finished right on that line or right up above that line, right? So that's going to be a resistance zone. This is going to be our R1 level. I'm going to tell our members coming into Tuesday, right? It's a longer term. It's next week or two. But that's where we can go to. If we don't get up above that and we roll over, well, the same thing can happen here. We can roll over, come down, and retest these lows. I'm sure every one of you this weekend or on Friday have read the news, especially those of you that follow the markets very closely, where it says you got one side saying now's the time to buy. The other half is saying, I think we're going to make new lows. This is just a counter-cyclical move in a bear market, right? Like a dead cat bounce is another way to say it. And then that's kind of where we're looking at going. And then if we move lower, then we move lower. So this is going to be a key level right around 4,300. You can just put that out there. That's going to be a key nut that we got to break and hold to get up higher. Now, let's just take this off the screen for a second. And how about downside? Where can we go if we don't get up there and we roll back over? Well, if I take it out a little bit, I got the Andrews pitchfork on here. Okay. These big thick bars represent Fibonacci extensions, not retracements, but extensions off that pivot high going into COVID and the COVID low. The small bars represent Fibonacci retracements from this pivot low at COVID low and this pivot high, which was all-time highs that were made on January 3rd for the S&P. Typically, when you run an Andrews pitchfork, it'll give you the general trend on the middle line, which in this case happens to be blue. So we could go down into a bear market and still be in a secular bull market. Cyclically, we're in a bear market, but a secular bull. And that could take us all the way down to around 3,700. Now, I told our members my range is 37 to 3,800. And when you have two independently drawn technical indicators line up very close to each other, like we've got right here, it's called an area of congruency. That means that that could be a really good solid stop point. And then the very next one down is an extension off that pivot high right there, which is right at 36.76. Typically, if we go down to 3,700, you'll see price action go right through it, and then just momentum will carry it down. So this is going to be my long S1 zone over the next couple of weeks. And we're going to break one of these. We're either going to break the 3,800 and go lower, or we're going to come up here and do the 30 or the 4,300 up here, which is very similar to that counter-cyclical rally right there. Okay. So that's what I'm looking at. So if I were to draw the lines, we got this as a break point, or we got this as a break point. And then this would be our soft cushion below that break point, which I don't think will go below. So let's just say we stay inside this zone here for 2 or 3, maybe 4 weeks until we figure out where we're going. Certainly leading up to the Fed on June 15th, because remember, we got an FOMC Fed meeting, and then boom, Powell takes to the press conference on Wednesday at 2:30 p.m. Eastern Standard Time. So this is what I'm looking at right here, guys. It's very simple for those that trade the index. Now remember, wherever the SPX goes, generally 70% of the stocks go there. And just as a tip, go into Thinkorswim and just pull up the S&P 500. You could do the S&P 100 too. And if you got over 90% going up on the same day, or down 90%, up 90% or down, that's considered very strong breath for the day. It's a bullish sign. And we had that, right? We had that on this weekly thing here. We had a lot of breath in it where the markets just about everybody went up. You couldn't go wrong. But that's also part of the fool's game. If you're waiting on, do I want to go in and set up a trade now that I'm going to hold for 6 months? I would wait. If we get up here, what you want to wait for is if we clear that line, come back and retest it and then go higher, that would be the area where you'd want to pull in a bull. I don't think we're going to get up there. I personally don't think we're going to get up to this 45, 4,600 this year. I don't think we'll see it. I think we're going to stay stuck in this range right here for this year. Now, there is a lot of uncertainty in these projections. I give it a 60% chance that we're going to go back lower to that 38 to 3,700 range, about 60%. The uncertainty is, how long does Russia and Ukraine duke it out? Any negotiated settlement, you're going to see oil drop by $8 to $12 a barrel at least. That'll put less pressure on inflation. Grain and food exports will start. That's one big thing out there. The other one, not including the Feds because they're always a factor, is if China gets Shanghai open fairly quickly over the next couple of weeks, and they can clear those ports out and we get normal supply chain flow, that's going to help too, okay? And as long as the consumer stays strong and inflation viewed by the market as is reaching its peaks, we're going to get CPI data in a couple of weeks. And as long as we see it going down and the rate of change stopping and going negative, meaning it's getting lower and lower, that's going to keep a bullish bent in the markets. So that's a little bit about what I'm seeing here in these markets, guys. It's just a macro view, you know. And no matter what you trade, you need to understand what the S&P is doing. Now, if we come over here and I show you just the S&P, different chart, different view, day chart, you can see here we hit 2022 lows rather on May 20th. We were actually down 20.81% intraday. Then we had a hammer formation, and then away we went. You can see the 50 EMA is sitting at 41.91. We closed the day at 41.68. So let's call it the 4,200 area will be the next level of resistance. And if we can get through there, then we're going to challenge the 200 EMA. Now remember what I said. When the 50 goes below the 200 EMA And in this chart, you can see it happening right here, right around April the 29th, around the end of April. So we spent most of May with the 50 below the 200 and both of them going down. Typically, it's a bear market chart. And what happens in bear market charts is price action inevitably will run back up to the 50 and challenge it and either roll back over or clear it, run up to the 200, challenge it, and then roll back over, and then we go right back down again. That's typical of a bear market. An average bear market lasts, at least 9 months, 9 months to a year and a half. And we haven't had one of those in quite some time. Right? Now, you can say technically we were in a bear market in COVID in March. Yeah, you could say that. But it was a black swan event, and it didn't last very long, a couple of months, and then boom, we were done. We were actually in a bear market for less than, I think, about 6 or 8 weeks, and then boom, we bounced right back out of it. But a true bear market is like 08, 09, or the dot-com bubble in 2001 and 2. It takes about a year and a half to recover from it. Okay. And that's kind of what we could get here, but there's a lot of uncertainty in the forecast. Also uncertain is what the Feds are going to do with interest rates. Keep in mind that the markets are pulling back a little bit in the 10-year and 10-year and 30-year interest rates because they don't see growth being as strong over the next 2 or 3 years. The Atlanta Fed has already reduced their Q2 GDP from, I think, 2.3 to 1.8. We got a revision to our GDP in Q1. I think it went up to a negative 1.5 from a 1.4 negative. So it's all going in the wrong direction. So the risk and the exposure is downside, okay, for those that are mostly long. So that's the way I would look at it, guys. And if we come over and look at the Dow, which is percentage-wise the strongest of the indexes, we'll look at the Dow futures. You can see here, we actually closed above the 50 EMA right here. We hit a low in the Dow of about 16.96% from the all-time highs on May 20th. Everything happened on May 20th. And now we cleared the 50. Now we got to come up to the 200. So my natural overhead resistance in the Dow is going to be right at the 200, which is about 34,112. Okay, right in that area there. So about 800, 900 points north. And that wouldn't take more than 2 or 3 strong days or a solid week to get us up there. Okay, so that's kind of what I'm looking at in the Dow. And that's where I'm looking to see where we're going to have trouble. I think near term, as I told our members a week ago, expect to move higher into the end of May, going into the first week in June, most strong momentum. It's going to slow down, and it's going to start rolling over in June, going into July. Okay, so if we take a look at the Russell, well, let's look at NASDAQ first. NASDAQ is the really underperforming. You can see again on May 20th, it hit a low of 31.47%. That's solid bear. You can see it's a lot further away from the 50 EMA too. We got to get up and test that. Until all indexes are over their 200 and their 50 EMAs, and they've been tested and they got solid support there, you've got to be very careful with these markets. All right, let me say that again. Until all indexes, the Dow, the Russell, NASDAQ, S&P, are over their 50 and 200, you got to be very careful. Right, now let's look at the RUT. If you look at the Russell futures, you can see it hit my target down on the downside, and we had a low of 30.97. The NASDAQ was actually a little bit 1 percentage point lower than the RUT. It came up, and now the RUT is testing its 50 EMA. See this test right there? That's classic bear market chart testing. Ran into it and roll over. Right here, we try to get up, because if you pass the 50, you still got to get over the 200. Otherwise, it's just not going to work, guys. So we've got a lot of damage to repair. Okay, and it's not going to happen in a week or 2 weeks or 3 or 4 weeks. We got to get a long run here, a rollover, find support, and then go higher than the prior pivot high from that initial run. Okay, that's what you want to see. Now, big money is buying some of the dips down here, and there's some good stocks. Members, as a reminder, we're not doing our weekly market watch Sunday evening. It's a holiday on Monday, so we'll get back into it on our pre-market trader session Wednesday morning. And I got some stocks we want to take a look at that are good buys right now. That I think, although they could go lower if we roll back over, but they're going to be 2-3 year good, great buys. If we come in here and we look at, let's say treasuries, let's look at bonds, 30-year bond. 30-year bonds is having that rally like I said it would. That's backing off interest rates. It's going to find a little bit of overhead resistance here, and then it's probably going to roll back over again. If we look at the 10-year rates, interest rates, you can see just the same thing. Rates made a high back on May 9th, and now we're coming back down again. It's going to find support at the 50, kind of consolidate down here for a while, and make another run higher. Okay. And then, of course, the U.S. dollar, same thing. We made highs in the dollar. It's coming down now. It's testing the 50 EMA. I told our members this past week to look at long euro. And I know there's been a lot of talk on the euro reaching parity with the U.S. dollar, but I don't see it right now. If they have a negotiated settlement between Russia and Ukraine, the first thing you should do is go long the euro. I mean, that would be like, or short oil. You could do both of those. Those are great trades, right? So that's a little bit about what I'm seeing in the currencies that excite me. Japanese yen, it just hit really. I think this is going to roll over. And when it rolls over and makes a lower low than here, that's when I'm going to look at buying the yen. It has just gotten cratered. If we go out to a weekly chart, just to give you an idea of how ugly it's gotten, there it is right there. It has just gone down. And then, starting here in March, it just fell off the table, right? Primarily because of the shutdown in Japan and China on their COVID policies, and the U.S. dollar being the only place where people want to be. It used to be the yen was a safe haven for currency and downward markets, but now it's the dollar. Kind of the only game in town. And then, of course, if we come down here and look at gold, our members know the only way to trade gold, we got the best way to trade it. Otherwise, it's going nowhere right now. You can see we're back in the green for gold year to date. We're above that blue line. That's where it closed last year. We almost made new 2022 lows on May 16th. Okay, that's a weekly chart. If I put it on a daily chart, zoom in a little bit, you can see here where we're below the 200, but the 50's above. So this is not a bear chart, guys. So I think longer term gold could go higher. Short term, I think it's going to bounce around. We got a great way to trade gold that just makes money. It prints money for you. So members, I'll remind you guys Wednesday in our pre-market trader session. Most of you already know, and you've learned how to do it in our Option Masters review. So that's a little bit about gold. By the way, it's the same thing with energy too. Okay, oil finished up on Friday. We zoom out on it. You can see where we're sitting. We're going to have a little bit of resistance here. It's a great time to put on our favorite trade in oil. Okay, I don't see it blasting too much higher very quick. If it goes up, it'll grind higher. But then the risk of the biggest fast move now is not to the upside, but to the downside. Okay, to the tune of $5 to $10 a barrel should we get some kind of negotiated settlement out of Russia and Ukraine. I don't see that happening near term, but all you need is a rumor and a front page headline in the Financial Times in Europe, and boom, there you go. Oil's going lower, right? Nat gas, meanwhile, natural gas is a mover to the upside, right? So let me just find out here, nat gas down here. You can see it had a down day on Friday, but look at it, we're making new highs. Now we're getting a bearish divergence here in these new highs. We call these poor man beds. But nonetheless, I've been saying it's going to stay up at this level up here north of 8 for a while because Europe needs nat gas and they need alternate suppliers. And Russia pretty much, they're cut off, or they're cutting themselves off mostly. So that drives nat gas higher. And there are a number of different ways that I've suggested we play this. We're making good money in the nat gas and oil plays, collecting dividends as well. Now, the other trade, I'll put that out here this weekend in this free update for you guys, is wheat. If we go look at wheat over here hit its all-time highs. not for 2022. It's all-time highs, period. At least going back to the 70s. And I don't think wheat's ever been that high before. $13.34 and a half a penny. Okay, right up there. Now it came down, profit taken, found support at the 50 EMA. It's coming back up. I want to see how this thing goes, but if I may just, even at this level, pick up a put in this. Wheat should not be this high. It should be at least down in the low 800s, not in the 1,000 area. Okay. But you got to go out in time and give the trade time to work. But I do like this trade to the downside. Anytime a commodity reaches a 5-year high or a 5-year low, a commodity now, not something like gold, which is a manipulated uh, commodity, but something like wheat, corn, food, ag, softs, coffee, sugar, or grains, corn, wheat, soybean, that kind of thing. You got the elasticity of demand coming in. When it gets too expensive, farmers substitute chicken for meat if meat gets too expensive. If meat gets cheap and chickens get expensive because of bird flu or whatever, then they just go more to meat. We're in the summer months where people tend to be buying more meat anyway right now. And don't just think of this as a problem just with the commodity, but with fertilizer too. The natural gas, nat gas is a big input component into fertilizer, the making of fertilizer. And because fertilizer cost is so high, a lot of farmers are substituting other products to grow or other things that they're producing, which cuts into the supply levels of wheat or corn and some of these other farm products. And what that does is the demand doesn't change. Demand stays fairly constant. And if you cut supply, then demand's going to just eat it up. And that's what drives these prices to all-time highs. And when you get up these levels, just hold your nose and go short. Go out about 90 days. The reason why I like puts in the futures market is it's a defined risk trade. You can't lose any more than the cost of the put. If you're a long a futures contract, or let's say in wheat's case, you're short a futures contract, you can have lock limit moves where it goes up. It doesn't even trade for the day. It just gaps up and it doesn't trade. And if you've got a long put, you don't have to worry. You're going to lose the cost of the put, but you're not going to lose 5, 6, 10x more than what the cost of the trade is. Right? So that's why I like it when you get to these commodity imbalances. All right, everybody, that's pretty much it. Just a really quick update. If you're not a member of our group, I highly encourage you to come in. You can make money, covers our costs all year in just one trade. Very simple. And you're going to learn a lot too. Members, I will see you Tuesday in our chat room. Otherwise, everybody have a great holiday weekend for those of you that have Mondays off. Otherwise, take care, folks. See you guys next weekend for our weekly roundup. Ciao, everyone.